What's up everyone, welcome back. Patrick here. Moving on to the next topic in cost volume profit analysis. We're now going to talk about operating leverage. And I'm going to show you how operating leverage is used first through an example before giving you the definition. So we have this scenario here where a company sells a product for $30 per unit with variable costs of $12 per unit, and then the fixed costs are $30,000. And what I'm going to do is create two different income statements for two different production levels or two different selling levels. So the first one is going to be if we sell 2,000 units. Next income statement is going to be if we sell 5,000 units. So we got the sales, variable costs, and then when we subtract variable costs from sales, we have the contribution margin. Then we're going to subtract the fixed costs, and then we're going to get the operating income. Now before I was usually putting profit here, but since we're talking about operating leverage relates to operating income. That's usually the definitions given in most textbooks, so I'm going to put operating income right there. And so what are the sales going to be if 2,000 units are sold? Well, $30 per unit, that's the selling price, so 30 times 2,000 gives us 60,000. And then the variable costs, $12 per unit, 2,000 units, so that's going to be 24,000. So the contribution margin is going to be 36,000. And the fixed costs are given as 30,000. So we're going to subtract that from the contribution margin and get our operating income of 6,000. And if we follow the same process for the 5,000 units, that would be the income statement right there. So notice that the fixed costs were the same in both because that doesn't change. Only the sales, variable cost, contribution margin, operating income changed, right? Because that production level was different. So we ended up getting an operating income of 60,000 over there. Now from here, we can get something called the degree of operating leverage. And what the degree of operating leverage is, it's basically the contribution margin all over the operating income. Right? So in this case, the degree of operating leverage is going to be the contribution margin of 36,000 over the operating income of 6,000, which gives us 6. So that there is the degree of operating leverage for this production level. And then over here, the degree of operating leverage, I'm going to put short form DOL there. It's the contribution margin, 90,000, over the operating income of 60,000, which gives us 1.5. Right? So erasing all this here, I'm just going to put degree of operating leverage is 6. And over here, degree of operating leverage is 1.5. So a couple of notes I want to make about this. Notice that the degree of operating leverage can be different for the same company. So the degree of operating leverage depends on that sales level, right? So notice that the sales were different, so the degree of operating leverage was different. So the same company can have different operating leverages or different degrees of operating leverage for different sale amounts. Now another thing I want to show is what if we increase the production level from this 2,000 units by 10%? So if we increase by 10%, that's the same thing as multiplying it by like 1 plus 0.1, right? That 10% right there. So it's like multiplying by 1.1. And that's going to give us 2,200 units of production now, or how many units we're going to sell, right? So 2,000, if we increase it by 10%, It's now going to be 2,200. So how's that going to affect the income statement? Well, notice 2,200 times $30 per unit. That's now going to give us 66,000 for the total sales. The variable cost per unit is going to go up as well. Or no, the variable cost per unit is still going to stay the same, but the total variable costs are going to go up. It's going to be 12 times 2,200, which would give us 26,400. And so notice then the contribution margin, if we subtract these, it's going to be 39,600. So the contribution margin went up. Notice that the fixed costs, they're still going to stay the same. So that's going to still be 30,000. So let's keep it in the same color. And so notice that the operating income now is going to be 9,600. Right? So if we change the selling level, everything on the income statement is going to change except for the fixed costs. Now with this new income statement and this old income statement, I want to calculate a couple of things. First thing I'm going to calculate is the change in sales as a percentage, right? So from the 60,000 to the 66,000. And the percentage change of anything, just in general, it's always the new amount minus the old amount all over the old amount. So if we're looking at sales, notice the new amount is 66,000, old amount is 60,000, so the difference between them is 6,000. And then the old amount is the 60,000. And so when we do that, we end up getting 0.1. And that's in decimals. If we want to convert it to percentages, multiply that by 100, we get 10%. So notice that the change in sales was 10%. And that makes sense, right? If the production level went up by 10%, sales is directly correlated to that. So the sales is going to go up by 10% as well. Now, what is the change in operating income as a percentage? Well, same thing, new minus old all over the old. So the new minus the old, so 9,600 minus 6,000 gives us 3,600 all over the old amount, which is 6,000, the initial amount. And notice we would end up getting 0.6 there. Multiply that by 100, that gives us 60%. So notice that the sales went up by 10%, but the operating income went up by 60%. And how do these relate? Notice with the degree of operating leverage. So if we take the percentage change in sales, multiply it by the degree of operating leverage of 6, we would get the percentage change in operating income. So another way to look at the degree of operating leverage is basically the percentage change in operating income all over the percentage change in sales. Right? So you may see a definition in your book saying the degree of operating leverage is the percentage change in operating income depending on the percentage change in sales, or some kind of wording like that. Right? So percentage change in operating income, 60 over percentage change in sales, 10, 60 over 10 gives us 6. So that's how those relate. And sometimes you may see this given as like another equation. So you may see percentage change in sales times degree of operating leverage, right? If we like cross multiply these to get another equation. Percentage change in sales times degree of operating leverage equals percentage change in operating income. So different ways that you can show this formula. But the way I'm going to show it is like this. Degree of operating leverage, percentage change in operating income over percentage change in sales. Now this also works if the sales go down. So let's say that this was negative 10%. So if the production level went down by 10% or the sales went down by 10%, then the operating income would go down by 60%, right? Be negative 10 times 6, which gives us negative 60. So we could show that here with this production level of 5,000 units. If it goes down by 10%, then we're going to be producing 4,500 units, or selling 4,500 units, right? So how I got that was just 5,000 times 1 minus 0.1, which gives us 0.9. So 5,000 times 0.9 gives us 4,500. And now we could fill out an income statement for that new production level. So notice that 150,000 times 0.9, or 4,500 times 30, that would give us 135,000. And then the variable costs, $12 per unit times 4,500 units, that would give us 54,000. And so the contribution margin is going to be 81,000, right? If we subtract those, notice the fixed costs, they're still going to stay the same. They're still going to be 30,000. So what's that new operating income going to be? It's going to be 51,000. Right? And so notice that for this production level, we calculate the degree of operating leverage to be 1.5. So notice that the sales, the percentage change for the sales was negative 10%. But what was the change in operating income? Well, the percentage change in operating income was the new minus the old, so 51,000 minus 60,000, which gives us negative 9,000, divided by the old amount of 60,000, that gives us negative 15%. You would get negative 0.15 in your calculator, and that gives you, when you convert that to a percentage, that gives you 15%, negative 15%. And so notice that these two relate by that degree of operating leverage, 1.5. Negative 10 times 1.5 gives us negative 15, right? So whether we are increasing by a certain percentage or decreasing, it doesn't matter. We could always use that degree of operating leverage. So if they gave you something like this and they asked you, if the sales go up by 50%, what's the operating income going to go up by at this production level? Well, you would take the 50%, multiply by 1.5, that would give you 75%. So it would go up by 75%, the operating income. Versus here, at this production level, if we increase the sales by 50%, well, 50% times 6 would give us an increase in operating income of 300%. Right? So it all depends on the production or the sales level that the company is currently at, and that is going to change the degree of operating leverage, and it's going to change the sensitivity of that operating income relating to sales. Now, another thing I want to mention, another way that operating leverage is commonly looked at is in terms of the fixed costs. And more specifically, the fixed costs as a percentage of sales. So notice that the fixed costs here are 30,000, sales are 60,000. So the fixed costs in this scenario are 50% of sales. Versus here, notice the fixed costs are still 30,000, but the sales are 150,000. And so 30,000 divided by 150,000 gives us 20%. So fixed costs are 20% of sales. And so notice that the higher the fixed costs relative to sales, the higher the degree of operating leverage. Right? So that's another way that many professors or many textbooks may describe operating leverage as well. Right? The use of fixed costs to generate sales. So the higher the fixed costs, the higher the degree of operating leverage. And when I say higher fixed costs relative to sales. So basically as a percentage of sales. The higher that fixed cost relative to sales, the higher the degree of operating leverage. And so the higher the degree of operating leverage, the more sensitive operating income is to changes in sales, right? A higher degree of operating leverage, the change in operating income is going to be more sensitive. It's going to change more as a percentage when the sales change. Now, the last thing I want to mention about operating leverage before finishing off the video is you could be looking at two different companies that have different cost structures. So notice that these two companies, we have their income statements here. Notice that the sales are the same and the operating incomes are the same. But notice that the cost structures are different, meaning that company one has lower variable costs, right? 20,000 versus company two has higher variable costs, while company one has higher fixed costs, right? As a percentage of sales, it's 60% versus here, 30,000 of 100,000, that's 30%. So company two has lower fixed costs. And so notice that the degree of operating leverage for both of these companies is going to be different. So for this company, it's going to be the contribution margin over the operating income, which is 4. While this company, 50,000 over 20,000, means the degree of operating leverage is going to be 2.5. Right? And that makes sense. Higher fixed costs, higher degree of operating leverage. We mentioned that before. Now, the difference with what's going on inside of these companies is, let's say that both of these companies, they are car manufacturers. If you have a car manufacturer that has lower variable costs and higher fixed costs, what that means is that there's going to be more machines in this company. There's going to be more automation. Right? Another thing you may see mentioned is that this company is going to be more capital or machine intensive. Right? So there's going to be less people working there. There's going to be more machines there. So less direct labor, right? So the variable costs are going to be lower. Versus a company like this where the variable costs are higher for that same level of sales and the fixed costs are lower, this company here, there's going to be more people working there. There's going to be more direct labor. It's going to be more labor intensive. Right? So not as much automation, not as many machines in a company like that. So a quick summary of high operating leverage versus low operating leverage. High operating leverage, you're going to have more operating income sensitivity to changes in sales, versus here you're going to have less operating income sensitivity. So you could think of maybe even a high operating leverage as being more volatile. Right? So if the sales increase, then the operating income is going to increase a lot. Problem is, if the sales decrease, then the operating income is going to decrease a lot. Versus this here, low operating leverage, it's a little bit more stable. Right? So not as high of an operating income increase if sales increase, but also not as high of a decrease if the sales decrease. And high operating leverage means higher fixed costs or higher relative fixed costs, versus low operating leverage is lower fixed costs. High operating leverage, more machines, less people. So more capital, more automation. versus with a low operating leverage, you're going to have higher variable costs. So there's going to be more people, more direct labor, less machines, less automation.